Welcome back. I'm Jeremy Szafron. Gold on the spot side holding right around $4,000 an ounce, a critical psychological level even as it consolidates off of its recent all-time highs. And this marks, of course, the strongest sustained rally in modern history. One of them, at least. I mean, it's the kind of move we've only ever seen really three times before: 1979, 2011, and now, each one tied to a crisis of confidence in paper assets. And if we look in stocks, I mean, we're seeing a risk-off week in equities as the S&P pulls back and the U.S. consumer sentiment hits a new three-year low. And the ongoing government shutdown is also creating a data drought, leaving many investors to navigate private data alone here. And money is rotating fast out of growth and into what investors perceive as the last refuge of value: real assets. And if we look at the broad market, while it's hitting the pause button here, it's a very different story emerging over in the entire mining sector as it's flush with cash. And that brings us to one of the biggest stories of the week. Wheaton Precious Metals just posted a record earnings and, of course, simultaneously announced a $670 million acquisition. And that combination, growth, yield, and zero debt, is almost unheard of in the business. Joining me now is President and CEO of Wheaton Precious Metals, Randy Smallwood, to break this all down. Great to see you.
Always a pleasure, Jeremy. Good to see you.
Well, listen, I mean, the market's clearly weighing uncertainty here with this consumer sentiment collapsing this morning. You, on the other hand, are deploying capital in every direction. Is your business simply insulated from the concerns hitting the rest of the market, or are you kind of actively taking advantage of them?
Well, those concerns in the rest of the market are what's providing support for precious metals, and so we see continued strength. And in fact, we're pretty comfortable with good, strong strength behind precious metals on a go-forward basis. And so happy to continue investing. We've already seen, as you've highlighted, a good, strong move in gold prices and for that matter, silver prices more recently. And so we're seeing a lot of investments, a lot of assets, a lot of opportunities move forward with construction decisions. And of course, we supply capital for those kind of opportunities, and so it's opened up lots of opportunities like Spring Valley for us.
Yeah, I want to get into Spring Valley, but let's talk about this 1, 2, 3 punch. I mean, you got these record earnings. You talked about the 6.5% dividend, which is kind of a little bit of an increase year over year. You can get into it, Randy. And of course, we got this massive $670 million acquisition all at the same time. I mean, is this the ultimate vindication of the streaming model, that you don't have to choose between growth and shareholder returns?
Well, I think it's a vindication that streaming is actually a very, very attractive source of capital for companies that are trying to build themselves. When you sit and look at how the equities are trading, they're still trading at a discount to the net asset value, whereas a stream is always priced based on the value of that metal. And so it's much more attractive than diluting your existing shareholder base by adding a whole bunch of new shareholders, pushing shares out. So as companies are trying to grow and build assets, this has been a good quarter for us. We added the Helo transaction earlier on this year too, which was ultimately a $300 million stream, and helped Helo Mining Corporation, HMC, acquire that asset. And so this quarter, close to $1 billion put to work.
Yeah. Let's get into that first deal. I mean, Spring Valley in Nevada. You finally got in there, huh? You finally got your feet into that area. I mean, it's obviously tier one. It's a $670 million check to an existing partner, which is Waterton. Why this asset in this jurisdiction at this time? I mean, what made it the first place you wanted to deploy that record cash?
Well, and Nevada has always been, one of, if not the most attractive place for the gold mining industry. Yeah. We've seen a lot of assets, a lot of royalties, existing royalties change hands. We've seen some stream financings. They all seem pretty expensive to us. And so, we've been patient and waiting for, an opportunity that's accretive. And so Spring Valley came forward. It's an existing partnership. Again, I think it's another example of the effort we put into being a partner of choice. We really try and help our partners be successful. We've already got one agreement with the Waterton Group on the Mineral Park mine down in Arizona, which is just ready to start production here anytime soon. And so it's a good, strong partnership, and looking forward to helping them on Spring Valley. The asset itself is a classic Nevada heap leach. It's probably 30 to 40% of the material will be crushed and stacked onto a heap leach pad, and the rest of it's going to be run-of-mine heap leach. It's an interesting one because the reserve was done at $1,800 gold. The resource at about $2,200 gold. You start putting spot prices on this, I don't know how much, and again, because it's a run-of-mine heap leach, I don't know how much more material is going to, I mean, we have a good idea how much more material is going to actually go onto that heap. And so we expect, I mean, on the current plan, based on those parameters, we're expecting about 28,000 ounces a year. I would not be surprised at all to see us getting well over 30,000 ounces a year from this asset on a go-forward basis, and excellent exploration potential.
Yeah, wow. Obviously, you brought up Hemlo there. That historic mine is closing this quarter as well. I mean, it's a significant amount of capital in a short time for you. Are you on an acquisition spree, or is this the new normal for Wheaton with gold at about $4,000?
Well, the way I look at it, Jeremy, we're paid to put our capital back to work, and we're generating close to $2 billion in free cash flow this year. As we continue to grow, we're well on track in terms of production. Our guidance for the year was between 600 to 670. We should be finishing in the top half of that guidance. The way things look, we've got 3 quarters behind us now. And so, and then we've got growth over the next 5 years that chases us up, over 900,000 ounces. And that's actually a pretty conservative estimate, because a number of our partners have now come forward with more aggressive expansion plans, moving forward expansions, or growing, or improvements, optimizations at the sites itself. And so, we're not far off of getting to that million ounce a year number, which has been a long time target of mine, is to be the first of the streaming and or royalty companies to actually get to that kind of production level. It's a whole new level. It's a whole new field for us. And we're so well on track towards that. It's just, it's exciting times. And so assets like Hemlo and Spring Valley are all going to just compound on top of that growth profile.
Yeah, let's talk about the why. I mean, at $4,000 gold, everyone's making record money. Newmont just posted $1.6 billion in free cash flow for Q3. Agnico posted $1.2. I mean, they're using that cash to aggressively pay down debt, fund this massive kind of buyback program, and they're almost in defense and return mode. I mean, most producers have to pick a lane, cut debt, buy back stock, or chase new ounces. Wheaton's doing kind of 3 all at once here. I mean, for anyone watching at home who's gold stocks or physical bullion, it's more than a corporate decision. It feels like it's almost philosophy. Been an interesting year for you, Randy.
It has been, obviously driving strong cash flows like this. The opportunity set, the strong prices has actually opened up the opportunity set. And although, the success of our model has brought in a lot of competition, a lot of companies that are chasing us in terms of the streaming model and even in the royalty space, the critical mass that we've got and that we're building on, it definitely gives us an advantage. What I'm particularly excited about is that we're starting to see, with these high precious metal prices, we're starting to see some of the diversified companies out there, some of the base metal companies that have substantive non-core byproduct precious metals production start to explore whether it's time to crystallize that value. And we'd love to do a few more streams like Antamina and Salobo, two very big assets in our portfolio where they're copper mines that produce substantive gold and substantive silver. And so if we can find some more opportunities like that, and with these kind of prices in the gold and silver space, there's definitely an interest at that level. So we're pretty excited. But as I said, we're close to $2 billion a year in cash flow now, and climbing well over that over the next few years with the growth profile. So, that's what we've got to put to work. That's what we're out there trying to find. In my eyes, that's what we're paid to do by our existing shareholders is put that money back to work effectively on accretive, well-structured deals to continue delivering what I would say the lowest risk, highest margin precious metals production in the space.
Yeah, it's interesting. I mean, I remember last time having you on the show, and I gave you a bit of a softball to explain the streamers. I'll try not to now. But I mean, for the retail gold investors watching right now who kind of understands owning a miner or GDX or maybe owning a physical ounce, but maybe not streams, why is the Wheaton model a better inflation hedge or maybe a better vehicle than simply owning the producers or the physical metal itself?
Well, it really comes down to the inflationary pressure that is one of the components that drives gold prices, that also drives up the costs. Mm-hmm. And then the other challenge that operators have is that as the commodity price climbs, what I would say high grade waste turns into low grade ore. And every time they process low grade ore, the cost on a per ounce or a per pound basis has to climb, because it's, your costs are generally tonnage based, but you're getting less metal out of each ton. And so, the inflationary pressure that you get, plus that swing towards making lower grade ores more economic and more attractive to process, all ultimately result in higher costs on a per ounce or per pound basis for the operators. With the streaming business model, we've taken a lot of that cost risk out. Our cost is defined in the contract. Typically, most of the new contracts is now around 20% of the spot price. So you've got a fixed margin of 80% on every ounce being delivered into our portfolio. And so, that confidence, that taking out of the cost risk, which I've always argued is the biggest risk in any mining investment, in any resource investment, is, how much is it going to cost to actually get the metal out, and what profit is there left afterwards? The streaming model takes a lot of that out. And so there's no doubt in a bull market, some higher leveraged exposure makes sense, but there should be a core foundation in your precious metals portfolio. And Wheaton should be that core foundation.
Well, let's talk about the risk on the growth side. I mean, the miner's risk is operational, a wall slide. Yours is contractual. I mean, with these new kind of big ticket deals, you're increasing maybe a little bit of counterparty risk. What happens to the model if a partner or a major asset kind of fails to deliver? Or, is it just kind of trading one kind of risk for another?
Well, that's the beauty of the streaming model, is that we are an equity partner, so we get a percentage of what's being produced. And so you're right. If there's a pit wall failure or some type of disruption, we also suffer through that. How we control that risk is focus on high margin assets. Focus on assets that deliver, healthy returns to all stakeholders, to the operators, to the communities around it, and to the streamers that are supporting it on a go-forward basis. And if there's a healthy return coming back to all stakeholders, there's going to be a very strong incentive to resolve any of these issues. You got a pit wall failure, you got some other type of disruption. There's a very strong incentive. And so Wheaton, 83% of our production comes from the bottom half of respective cost curves, which means these are the most profitable mines in the world. And those profits are what drive our operators, our partner operators, and for that matter, the communities around them to also prosper from these operations, to ensure that production continues and goes forward. So, at Wheaton, we're very selective about which assets we invest into. And one of the reasons is because we do share that risk from a delivery perspective. Our costs are controlled, but we do share the production risk. But that also allows us to share the production upside. When we see exploration success, expansion potential, all of that also comes to us side. So, we are an equity partner from that perspective. It's the cost risk that we really limit.
Yeah. You've said in the past, your model is safer because your costs are fixed, right? I mean, $4,000 gold world, is that a disadvantage? I mean, a producer's costs are also mostly fixed, so their margins could explode. Your payments to them are fixed too. Are you just, the leveraged gold bond with less upside?
Well, I mean, the nice thing about prices this high is that it is driving a lot of investment into the space. A lot of projects. I will say Spring Valley probably wouldn't move forward in a $2,000 gold market. It looks attractive, but to put the capital in and the returns, it wasn't. It's not an asset that had great shine at $2,000. However, at $4,000, it's a fantastic asset going forward. And so we are seeing, these higher prices do open up more opportunities for us to continue putting the money back to work. And I'm confident that we'll continue to do that. We've got $2 billion to spend this year. Got to find a few more deals.
Yeah, no kidding. Are they getting a little bit harder to find, Randy? I mean, there's some good capital out there being put to use.
Yeah, I mean, clearly the markets are starting to wake up, but we're still not seeing good support. And so typically what we compete against as a streamer is equity, is companies issuing shares versus doing a stream. And, I've seen some companies sort of portray that as being somehow better than a stream. When you issue shares, that's life of mine. You've sold those shares out and you've diluted your existing shareholder base on a go-forward basis. And then typically when you look at today's market, most of those shares are trading at a discount to net asset value. So you're actually, quite dilutive, and a stream just competes well on that front. And I think the more executives, the more CFOs of resource companies out there understand about the streaming model, the more they realize how much more attractive it is. Capital from a stream is nowhere near as dilutive, and it typically dramatically improves the internal rate of return for the operator's shareholders going forward. And that attraction, that fact that we're contributing such a larger portion of the capital than the revenue that we take away, a percentage of the revenue we take away, just makes it inevitably attractive for CFOs that are trying to finance growth.
Yeah, no kidding. Let's zoom out a little bit and talk macro. I know you always like to talk about it. I mean, the uncertainty in the broad market is palpable. The market's kind of flying blind because we've got this government shutdown, and so is the Federal Reserve. I mean, we have no official jobs reports, no CPI yet. The market's still pricing in a December rate cut. You're on record talking about that $10,000 gold, right? I mean, we're sitting here at 4,008. We've had a small little correction. You've said that this is an insurance against reckless policy. Is this the first kind of real test of that thesis where sound money assets like gold are finally separating from the fiat system?
Well, we are definitely seeing that. I'm comfortable with what we've seen. It did accelerate quite rapidly here in the last while. So to have it build a foundation around $4,000, we're still seeing continued investment from central banks around the world who are, really concerned about their exposure to fiat currencies, specifically the U.S. dollar. And we haven't seen a solution on the excessive debt that we see not only in the United States, around the world. Canada, of course, just came forward with its first budget. Record deficits, one of the highest that they've seen outside of COVID. I think it is the highest outside of the COVID years in terms of a deficit going forward. And there's no path towards a solution here. The only solution is gold.
Yeah, yeah. And, speaking on that, I mean, there was some initiation, or at least talks about miners being more friendly with government, kind of getting these things fast tracked. We didn't see much of that coming out of the budget in Canada as well.
Well, there's a lot of rhetoric out there, but we just haven't seen, hard crystal. We've seen, commitments towards 2-year permitting programs and stuff like that. One of the biggest challenges for resource companies trying to develop projects is the time that it takes to get through the permitting process. It's not so much the permitting requirements around it. It's just the length of time. Time is very expensive from trying to advance these projects on a go-forward basis. And so, we'd love to see something more substantive than just the rhetoric. We are starting to see some investments from different government agencies, specifically more so out of the U.S. I'm not sure that's the path we should go down. If you can just, clear the pathway, open up the channel towards permits so you can actually move these projects on a go-forward basis, I think that should be more than enough for the industry to deliver what's required.
I got to ask you about the World Gold Council just reporting, because I know that you obviously you have been with them for a long time. I don't think you are anymore, but I mean, they just reported that the National Bank of Poland led global central bank demand back in October. They bought over 16 tons. I mean, it's bringing their holdings to 530 tons, roughly 26% of total reserves, even after gold's 50% rally this year. I mean, you and I have talked about it again. The central banks have not decreased buying, especially at these levels. That continued accumulation telling us that official sector is still voting no confidence in fiat currency, kind of that shift from U.S. treasuries towards hard collateral?
No doubt. And I'm still heavily involved in the World Gold Council, still in the executive committee of the board itself. It's an incredible advocacy group that has plenty of capacity and is doing some great things, some exciting things. But the one thing that I think they do supply is some pretty good data in terms of that, and you still see strong trends in terms of central banks around the world realizing that they have to stand on their own 2 feet. They can't rely on other countries, other commodities, other currencies in terms of the strength of their own sovereign wealth, and so. Countries like Poland, you sit and think about where they are from a geographical perspective. They need to be able to stand on their own 2 feet. And so they don't want to be beholden to any other entity, whether it be the US or the euro or any other fiat currency. And so, not surprised. You've seen a lot of countries in Eastern Europe recognize just because of what's been going on around the world. Asia, of course, extensive commitment towards expanding gold. The ETFs in India, huge increase in demand in gold, and so it's a worldwide phenomena that I think is going to continue to grow. We haven't seen full uptake into the retail space yet, and so I still think there's plenty of space for us to go on the retail side. I think that's really probably supported best by looking at the equities in the gold space. And how we solve that, we deliver results, and that's what we're doing at Wheaton. And there's a lot of companies in this space. You started off by talking about some of the other companies in the space. Start delivering the results, and that will bring back the shareholders.
Yeah, I mean, the contrarian in me, of course, would argue that the kind of euphoria we're talking about, that gold over 4,000, these record earnings, and everyone flush with cash, and you doing $670 million deals is kind of precisely the setup for a major top. I mean, what's the argument that this isn't 2011 all over again?
Well, it's just tough to find strength for the US dollar. You can't talk about the price of precious metals without talking about the measuring stick that we're using, which is the US dollar. Whenever we talk about how gold's performing, we measure it in terms of what it's trading in US dollars. And show me a path towards long-term sustainable strength in the US dollar. We can see short-term, there's no doubt there's going to be short-term fluctuation strength. We're seeing some of that, I think, right now. But is there a solution? Is there a real viable solution to the debt challenges and the excessive spending and leverage that countries are going through? The United States is now spending more money on interest for debt than they are on defense. Mm-hmm. That's usually the sign of the end. Go back and look in history, and so and we're seeing that around the world. As I said, he was talking about the Canadian economy, or whatever, the budget that just came out of the government here. Again, no strength at all here in Canada, right? And so it's tough to find something, and we're going to have, it's not going to be a straight line up by any means. There'll be some fluctuations and volatility and such, but what I see is continued foundation building. We've seen good, strong strength at $4,000 gold. It hasn't moved much off of that, and I don't think it's too long. I still stand by. I don't see a problem with $5,000 gold by the end of next year, so the end of 2026, and $10,000 by 2030.
Yeah. Okay. I like that. That's a good little thing. I got to ask you about silver, because I know from our last conversation, it's your favorite metal. The U.S. government has just added silver and copper to its official critical minerals list, putting them in the same strategic category as lithium and rare earths. I mean, it's a pretty big shift, especially for silver, which has been long treated as a precious metal, is not an industrial necessity. I mean, it's holding at 48 and a quarter, about there today. Your attributable silver production was up about 32% this quarter. Is that the outperformance lag you told me about? Is the structural deficit finally here?
Well, you're right. Silver is my favorite metal. I think it just has a lot of the same attributes as gold, plus a few other attributes that make it more attractive. The fact that it's, in my eyes, probably one of the most critical minerals out there, because the more silver we use in any industrial application, the better performance we get, whether it's longer battery life or higher processing power. There's a reason so much silver is used in solar panels. That's how you make them effective. It's how you make them, economic in terms of actually delivering power. And the same thing with mobile phones and mobile electronics, mobile rings, or watches, everything like this. The more silver we use, the better we are, the more efficient we are in terms of producing and consuming. And so the other side of silver is there's not a big silver mining industry. Most silver comes as a byproduct, mostly from lead zinc mines, and so lead zinc prices aren't high enough to stimulate reinvestment. And so we have seen peak silver production. We saw it probably 2018, and declining production pretty well ever since, declined to flat. And so without an increase on the supply side, an increasing demand in terms of efficiency, happy to see it on the critical mineral list. I've always felt it should be on the critical mineral list. Yeah. The one advantage to silver is that it is pretty widely available. We don't see a lot out of Africa, and there's a few spots in Australia that produce a lot, but the Americas and China are definitely, Mexico, Peru, and China are the three biggest producers of silver. Again, it's the fact that it's tough for us to find silver investments is, again, a supporting factor behind silver. And so we're pretty comfortable with, our silver share. I'd love to have a bit more. Mm-hmm. I do think that, one of the highlights of Wheaton is, again, that we are essentially pure precious metals and probably some of the best silver exposure that you can find in the space. And so love to add a bit more. We do have a lot of optionality in silver, number of projects that are long dated out, but would represent well over 10 million ounces of silver production per year if they ever came to fruition. So we do have some good optionality on the silver side too.
Yeah, it's interesting. I mean, you kind of talked about it. I mean, you've said before that base metals like copper or nickel are kind of non-core to your model, but with the U.S. now declaring copper and even silver as critical minerals, that seems to be changing the game. Are base metals still just a byproduct for Wheaton, or are you quietly kind of evolving into a broader strategic metals company?
Well, we don't. No. We're 100% precious metals, but
Yeah,
but
yeah.
keep in mind, most of our product, over 60% of our production, comes as a byproduct from copper mines. So, the base metal industry is very important to us. We supply capital to the base metal industry to help build those mines and help those companies grow. And so, what we're chasing is the non-core byproduct precious metals from those copper mines, those lead zinc mines, those nickel mines. And so, it is important for us to see support in that base metal space because it opens up opportunities if we see companies growing in that. I do think the next phase of the streaming model is going to be supporting some very large copper investments coming down the pipe over the next 5 to 10 years. And I can tell you the scale of those assets, the scale of those investments is going to be 5 to 10 to 15 billion dollars in terms of total capital in. And so there's plenty of space for streams of the multi-billion dollar variety to help out in that space. And so I think we're perfectly positioned to help some of those companies build these large scale copper assets and get some byproduct gold from those assets. And so we patiently wait.
Patiently wait. Still with these costs. Okay, well, let's bring it home. I mean, you laid out your case for this do-it-all model that seems to be working. We talked about that significant risk to the counterparty risk. This quarter wasn't just about deals. I mean, your production jumped 22%. Your release kind of specifically cites the ramp up at Blackwater and Goose. You've been promising 40 to 50% organic growth for a while. How de-risked is that path to becoming a 1 million ounce producer by 2029?
Well, 2029, if we keep on making acquisitions like Hemlo and Spring Valley, that shouldn't be a problem. We're on track. I mean, our current guidance has us to 870,000 by 2029. I think our current guidance has us reaching 1 million ounces a year by 2031. And so we do have, over 7 years, a path to 1 million ounces. But as I said earlier on, our current production profile is actually very conservative. We've had Blackwater come forward with a more aggressive expansion schedule. We've had Salobo come forward with some optimization at their site to improve throughput and recovery rates. Antamina, of course, much higher grades. Platte Reef accelerating their expansion schedule going forward, hoping to ramp up to full production much earlier. We've had a number of assets move forward. Cangrejo with CMOC is now expecting to be up and running by 2029. We've had a number of our other assets, Copper World and Santo Domingo, where our partners have found joint venture partners to help build those and move those forward. And so I think there's actually a pretty good likelihood we'll see 1 million gold equivalent ounces of production by 2029. We've also seen, and not that it's just a numbers game, but we've seen silver outperform gold here, which of course helps us a bit on the gold equivalent ounce ratio, that calculation. And the fact that we've got such a substantive silver portion of revenue that will help us as silver continues to outperform too. So yeah, I'm pretty excited about the chance. We're definitely on a path there. We will see it. It's a matter of, is it going to be 2029, 2030, 2031? If we keep on adding assets like Hemlo, of course, which delivers immediate production, or Spring Valley, which has got about a 2.5 year construction period, that just brings us closer to that 1 million ounces even faster.
Yeah. All right. Well, our time's almost up. You brought up Hemlo before. I mean, it seems like it's almost under the radar. I mean, huge projects, some huge names. I mean, Quartermain was one of the geologists who was kind of behind that in the tech days. I mean, exciting project ahead here. Yeah,
no, we're happy. I mean, it was a great example of the benefits of having a streamer as a partner during an acquisition process, because we had dual technical teams going through and testing this project to make sure that it was worth it, that it had that value, and where's the opportunity, what can we see. And so our team, along with Bob Quartermain, was actually on the tour with us. Brought his old notebook from way back in the tech days and was comparing notes from from when he spent several years there working with Tech back in the early days. And so just being able to experience that with someone of Bob's stature was quite quite a treasure.
Yeah.
And we just see there's all sorts of opportunity. Barrick was making production decisions there based on $1,400 gold. $1,400. That's just about a third of just a little bit over a third of the spot price, right? And so when you see prices like that, there's incredible opportunity. All we did was push it up to a little bit over 2,000, and we saw immediately another 10 to 12 years of life added to the asset.
Wow.
So it's an asset like that. I think all assets kind of get to that stage where sometimes it doesn't. It's time to take it out of the big company and put it into a much leaner, more efficient, tighter organization. And so I think we've definitely going to see that with Hemlo.
Yeah. Okay. Well, we'll end on a personal perspective because this interview is going to kind of live over the weekend, Randy. You've been in this business for decades. You've seen every cycle. Does this one feel different, not just in price, but in the psychology of the market? It feels like.
Yeah, the foundations behind this bull cycle are much stronger. It's a recognition that there's a challenge with the measuring sticks, the fiat currencies that we use to measure value and to store value, and there's nothing that's going to change that. It's a breakdown of that system, and I think that's where again, as I said earlier on, I just can't see anything providing longer term strength, sustainable strength to those fiat currencies. And so it bodes very well for us in the precious metal space.
Yeah, well said. Randy Smallwood, CEO of Wheaton Precious Metals. Thanks for this, Randy. Congrats on this record-breaking revenue. Speak soon.
Always a pleasure, Jeremy. Thanks.
Appreciate it. And don't forget to hit the subscribe button right here at Kitco News. I'm Jeremy Szafron. For all of us, thanks for watching. We'll see you next time.